Welcome to the Deep Dive, our mission today, to really unpack how U.S. tax policy works, how it shapes the economy, the financial markets, and ultimately provide you with some essential insights. We've dug into a pretty exhaustive analysis covering, well, everything from tariffs, corporate, personal taxes, some big historic reforms, and honestly, some surprising future policy twists. Think of this as your shortcut to getting truly informed.
Absolutely. And it's key to remember tax policy is full of really complex trade-offs. There's rarely a simple answer. We're here to connect the dots for you, focusing on what actually matters for your understanding, getting beyond just the headlines.
Okay, let's dive in. First up, tariffs. They often get pitched as, protective shields. But the sources we looked at, they paint a picture of a double-edged sword. The data clearly shows they tend to raise consumer prices. For instance, the CBO, that's the Congressional Budget Office, they project a 0.4% bump in inflation from tariffs by 2026.
And Yale's Budget Lab. They estimated an average hit to household income of about $3,800 by that same year. That's significant.
It is. And the overall effect on GDP. The CBO sees a drag, projecting a 0.6% reduction by 2035. It's not a huge number, but definitely negative.
Yeah, and to make that concrete, think about the solar panel tariffs example that came up. The idea was, okay, protect U.S. manufacturing. Seems straightforward, but the sources really highlighted this jobs paradox. Protecting those manufacturing jobs actually led to an estimated 62,000 job losses in the solar installation sector.
Wow, 62,000 lost versus gains elsewhere.
Exactly. It shows how trying to help one area can, unintentionally ripple out and hurt a much larger segment of the economy. It's that trade-off dynamic again.
Okay, moving beyond tariffs, let's talk corporate taxes. This hits company, bottom line, stock performance, everything. Remember the big 2017 Tax Cuts and Jobs Act, the TCJA?
Oh, yeah, big one.
It slashed the corporate rate, took it from 35% way down to 21%. And that had a pretty immediate direct boost to after-tax earnings per share for companies.
Right. It boosted earnings, no question. But the really critical point, and maybe where there's some debate, is what companies did with that extra money. The sources point to a lot of it, maybe around a projected $1 trillion just in 2025, going back to shareholders through stock buybacks, not necessarily into broad new investments, R&D, or big wage increases across the board.
And here's something I found genuinely fascinating about corporate taxes. You'd think tax hikes would tank the market, right?
Intuitively, yes.
But get this. Historically, going back to 1950, the S&P 500 actually rose in the first year after corporate tax hikes. The average gain was around 13%.
13% gain after a tax increase.
Yeah, it's wild, but it really shows how other factors, especially monetary policy, think Federal Reserve actions. Interest rates often just overshadow tax changes in the short term for market sentiment and corporate profits.
That's a really important point. So if corporate taxes have these complex effects, what about personal taxes? How do they ripple through?
Well, the basic idea is personal tax cuts boost disposable income, which can boost consumer spending. Pretty standard.
But the impact isn't always the same. It really seems to depend on whether people think the cuts are permanent or temporary. Temporary ones, people tend to save them.
Ah, okay.
But if they seem permanent, they're much more likely to be spent. And who gets the cut matters too. Lower and middle income folks. They tend to spend a higher chunk of any tax cut they get, so that stimulates the economy more directly, more quickly.
All right, so that brings us to what's next. And folks, you need to be aware of the 2025 tax cliff. It's a big deal. Basically, most of the individual tax cuts and the pass-through provisions from the TCJA, the ones affecting lots of small businesses, they just expire at the end of 2025.
That means unless Congress acts, you're looking at higher individual rates again, the standard deduction gets cut in half, and that qualified business income deduction, the QBI, it disappears.
And that QBI deduction is huge for small businesses, letting them deduct up to 20% of their income. Losing that will hit millions.
Yeah. So Congress is looking at ideas. Our sources outlined one hypothetical framework called the One Big Beautiful Bill Act, or OBBA. The goal there seems to be making many TCJA individual cuts permanent, but also adding some new things, like deductions for interest on car loans for U.S.-made cars, even a deduction for tip income.
And what's really interesting, or maybe controversial depending on your view, is how this OBBA framework uses the tax code for other policy goals, like immigration policy.
How so?
Well, for instance, to get tax credits like the child tax credit under this proposal,
Yeah.
every single person in the household would need a work-authorized Social Security number.
Wait, every person. So even if the child is a U.S. citizen.
Right. If the parents file using an ITIN, that's an individual taxpayer identification number, common for non-citizens, their U.S. citizen kid could be denied the credit. It links tax benefits directly to immigration status across the whole household.
That's a significant policy integration right there. Yeah, okay, one last crucial piece. Dynamic scoring. This is kind of a newer reality in how tax policy gets analyzed.
Explain that a bit.
Well, the CBO's models, they now incorporate these dynamic effects. And what they're finding, especially now with high government debt, is that the negative effects from more government borrowing, like potentially crowding out private investment because the government is soaking up available capital, could actually outweigh the positive incentive effects you might expect from a tax cut.
So the old idea that tax cuts automatically pay for themselves through growth.
Exactly. That assumption is being seriously challenged by the CBO's own scoring now, especially given the current debt situation. It highlights just how complex these fiscal trade-offs are.
So wrapping this up, what's the big takeaway for you? It's clear U.S. tax policy is this intricate web of trade-offs. Outcomes are really influenced by monetary policy, by debt levels, and often they're not what you'd intuitively expect.
Absolutely. And maybe a final thought to leave you with. Given all these complex dynamics, and especially with that 2025 tax cliff looming, how might you start thinking about strategically adapting your own financial plans, your investment decisions, to build some resilience for what looked like a period of real policy uncertainty? Something to definitely ponder.